March inflation data came in better than expected. Inflation continues to cool. What should you do about it? I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, guys, we got good news on inflation. We got the reading just recently on for March, okay? And I will tell you, right? So January, we started the year, this year, 2023, the stock market had one of its best Januaries ever, and everything was riding, rebounding because the hope and expectation was that inflation was actually working its way down. And then in February, all of the inflation indicators that we got in February for January, they were all worse than expected. Inflation was showing signs of being stubborn, and that created a cloud on the markets and economy for February and March. And of course, the banking crisis, regional banking crisis that kicked off in March didn't help things either. So this is a breath of fresh air. We got inflation data just recently coming in, annualized 5% inflation. That is slightly better than what was expected. And you can see here from the chart that inflation has come down significantly from those high points. Now, guys, you know that most of this isn't due to prices coming back down. Inflation is a rate of change number. So as long as prices don't continue rising at the same rate from, 13 months ago as they are right now, then inflation should start cooling. And yes, the price of eggs and the price of rent specifically has been coming down a little bit. So there are areas where prices are starting to come down, not back to where they were pre-COVID and pre-inflation, but they are coming down a little bit. But for the most part, guys, the idea with inflation going away or cooling off is just that the rate of change, that the price increases from here on out won't be as high as they were right after we printed $5 trillion. So it was expected that inflation would cool, and it came in at 5%, which is better. Now, to me, my worst case scenario, my biggest concern about the stock market and the economy in the short term is that inflation is stubborn or that it spikes back up. Last time we had hyperinflation like this, early 80s, inflation went up, it came back down, then it went up again, and then it came back down. And so, guys, that's my greatest concern right now. The other concern is that inflation goes up, comes back down, and then it stays at an elevated level for a lot longer time period. Those are my concerns. No one knows the future. I don't know. But this data suggests, no, inflation is continuing to cool. So those risks, while still present, at least seem a little less risky at the moment. So if you follow all of that and are in the camp that no, inflation is going to continue to cool, or if it does, then what should you do? There's 3 moves that you should make. Number 1 is investing in the stock market for the long term. If inflation is going to continue to cool, the stock market for the long term, this could and should be a good entry point. Now, I'm a believer in the markets long term. So if you're investing, you're either a trader or investor or a saver, okay? A trader is someone that has a specific trading scheme, strategy, and they're looking for short-term moves. That's not our approach, okay? And if that's your approach, I hope you've got a fantastic strategy, because the right strategies can work, but just kind of dabbling in it typically proves to not work. So if you're a trader, then you're looking for short-term moves, okay? I'm talking to investors, okay? To you investors that say, well, I'm in my 40s, or I'm in my early 50s, or I'm approaching retirement, and this money that I'm investing right now, I'm not going to need to touch for 10, 15, 20, 30 years, a long time, right? Those of you that say, well, the stock market might be lower in a month, it might be a little bit higher next week, it might be lower a year from now, but 10 years from now, odds are the market's going to be higher. 20 years from now, there's never been a time period where the market hasn't been higher. That sort of thing, okay? That's who I'm talking to. Savers, by the way, those are folks that really should be taking very, very little risk and dabbling in the stock market. As soon as things get volatile, they get spooked out of it. So that's the thing. If inflation is officially cooling, that should be good. That should be good for stocks. Now, just full and fair disclosure, during high inflationary times and low inflationary times, stock market does pretty good when you look back historically. I would expect volatility in the short term because we still need to wrestle through this banking crisis and whether we do see an official recession and how deep it gets. So stocks in the short term are likely to still be volatile. But if inflation is officially cooling and we don't see a double spike or we don't see this stubborn high inflation, stocks for the long term should be your first change or your first go-to. The second thing to do if inflation is officially cooling is bond investments should look attractive. Bond investments should look attractive. We had the worst year in the bond index, which I'm not going to get into that. That can be confusing, but worst year in the bond index ever last year in 2022. And why was that? Well, the Federal Reserve interest rates needed to go up so quickly, and bond investments are like a teeter-totter. So as interest rates go up, bond investments go down. Or think of it this way. If you held a bond mutual fund or a bond index fund, if previously issued bonds were paying 2 to 3%, and all of a sudden new bonds that are being issued are paying 4, 5, 6%, or even 7%, how attractive are the old ones that were only paying 2 and 3%? Not very attractive. So they still are going to pay their interest and then pay out their principal at maturity, but the value, if you wanted to sell it in the short term, went down because new interest rates were much higher than the old ones. And so that's sort of how that works. But holding that bond investment to maturity, it still will mature at par, okay? And the bond funds that, the bond index, the bond funds that we use right now, they're trading the average price of the bonds within those funds are below par. So if we see inflation cooling, then that means we shouldn't see interest rates spike again, okay? And therefore these bond investments or these bond weighted prices should get closer and creep back up. There should be some capital appreciation or reappreciation back to par. If inflation actually comes down so much that the Fed starts to lower interest rates and interest rates throughout the yield curve start coming down, we could actually see that appreciation happen pretty quickly. So I still think stock investments offer a greater return for the long term, but your bond investments should start looking attractive if we're seeing inflation officially cool. So that's two things to do. If inflation is officially cooling, the stock market should be attractive for you long-term investors. Bond market should be attractive as well, not to make a short-term buck, but as you're managing risk, your bonds, that area of your diversification should be attractive as well. The third thing that I would have you do if inflation is officially cooling is lock in for your fixed investments, lock in high interest rates for as long as possible. Now, right now, we're seeing CD rates in the 5% range, and that's been challenged, that's been complicated with this regional banking crisis. There are fewer and fewer of those out there, but those are the rates right now. And you might say, oh my goodness, if I can get a CD for 5%, let me lock that up for 10 years. Well, you can't do that. That's the yield curve, right? The interest rates in the short term are really high. Interest rates, if you looked at 3-year CDs or fixed investments or 5 years or 10 years, they're going to be slightly lower than what you can lock it in right now. But if, again, inflation is cooling, then interest rates will likely follow. And for those of you savers, or if you're near retirement or at retirement or early in retirement, or if you've got too much cash because there's an upcoming purchase or you're going to retire and you're sitting on some cash but you don't need it until a defined time period, I would look at locking in some of that money or a reasonable amount of that money that fits within your overall financial plan into these high fixed rates, whether that's a CD or some other fixed instrument, something like that. Locking in these rates for as long as you can reasonably get, I would say makes sense if we're going to see inflation continue to cool, because interest rates will follow, and these interest rates won't be around, that you can lock in at right now, won't be around forever. There's more than that. There's more ways that if inflation continues to cool, changes you should make in your overall financial plan. But those are the three that I'd have you consider and work with your certified financial planner on. Make sure that certified financial planner is looking at all 6 areas of your financial life, because any of these ideas maybe look good or maybe look bad in a vacuum. You've got to look at all 6 areas of your financial life to determine, well, which adjustments do you need to make if inflation is continuing to come down. And then additionally, guys, I wouldn't just take any of these in a vacuum, because there is that chance that inflation actually spikes back up, or that it stays at 5% and elevated for a long period of time and doesn't continue marching down. So you've got to have that contingency plan in place as well. That, again, is why you need one plan, a comprehensive financial plan. Work with your CFP on that. If you don't have a CFP on your team, contact one on my team. You can find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well. Or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.